There is a single, fatal, and almost universal mistake that condemns the average speculator to a career of frustration and loss. It is a practice born of a toxic mixture of hope and ego, a practice that stands in direct and perfect opposition to every sound principle of speculation. This is the amateur's habit of averaging down, of adding to a losing position. He buys a stock and it declines. The tape, in its clear and impersonal language, is telling him that his initial judgment was wrong. But his ego cannot accept this verdict. He refuses to take the small, clean loss. Instead, he views the lower price as a bargain and buys more, hoping to lower his average cost. He is not speculating. He is arguing with the market. He is throwing good money after bad, sending his precious capital reserves into a battle that is already being lost. He is reinforcing failure, subsidizing a mistake, and denying the evidence of his own senses. He has abandoned the science of tape reading and has entered the realm of wishful thinking. This is the speculator's mortal sin, and it is the surest and most direct path to the poorhouse. The master speculator, the man who has survived and prospered in this most difficult of games, operates on the exact polar opposite principle. He never, under any circumstances, averages a loss. He understands that his first duty is the preservation of his capital. Instead, he has perfected a scientific method for building a large and profitable position. This method is the art and science of pyramiding. To understand the pyramid strategy is to understand the very heart of Jesse Livermore's operational philosophy. It is a method designed to work in harmony with the market, to build a position with the lowest possible risk, and to transform a correct initial judgment into a truly great fortune. This professional approach to building a line of stock is one of the central recurring themes in the chronicles of his life. The wisdom is timeless, and its study is essential for any serious student of the markets. A link to Edwin Lefebvre's indispensable work, Reminiscences of a Stock Operator, can be found in the description below this video. The pyramid strategy, in its essence, is the practice of reinforcing success. It is a method of adding to a position only when it is showing a profit, of buying on a scale up as the market's own action continues to prove that one's initial judgment was correct. It is a complete philosophy, a disciplined and logical process that begins long before the pyramid itself is constructed. It is a campaign, and like any successful military campaign, it begins with a single cautious and exploratory maneuver. The entire foundation of a successful pyramid rests upon the outcome of the initial probe. A speculator, having identified a stock at a pivotal point, does not rush in with his entire line of capital. That would be a reckless gamble, a bet on an unproven opinion. Instead, he makes a small initial purchase. He buys a fraction of his intended full line, perhaps a fifth or a quarter of the total. This first trade is not a commitment, it is a test. It is a question he is asking the market. My study of the conditions suggests this is the moment for a major move. Am I correct? With this probe, he has established a beachhead. He now has a vested interest, and his focus on the stock's behavior becomes preternaturally sharp. But his risk at this stage is minimal and strictly controlled. Now comes the most critical moment in the entire process. The market must deliver its verdict on his probe, and that verdict must be immediate and positive. The stock, having been bought at its pivotal point, must act right. It must show him a profit, and it must do so quickly. This immediate profit is not just money, it is the market's confirmation. It is the state's way of saying your judgment was correct. The line of least resistance is indeed in the direction of your trade. It is the validation the speculator needs before he risks another dollar. If the stock, after being bought, hesitates, becomes sluggish, or falls back below the purchase price, the market's verdict is equally clear. Your judgment was wrong. The disciplined speculator accepts this verdict instantly. He closes the position, takes a small planned loss, and moves on. He does not hope. He does not wait. He obeys fate. A trade that does not show a profit from the very beginning is a trade that is likely to end in a large loss. The speculator must demand its immediate proof from the market. successful, if the stock moves decisively in his favor and shows him a clear profit, then the second stage of the strategy begins. The speculator now has a new and powerful form of capital at his disposal, the market's own money. His original risk capital, the money he used for the initial probe, is now protected. The paper profit from that first trade becomes the new risk capital for the next stage of the campaign. He is, in a very real sense, now playing with the house's money. This creates a profound psychological advantage. His mind is clear and free from the fear of a loss on his original capital. He can now operate with a greater degree of confidence and objectivity, his judgment unclouded by anxiety. With his judgment confirmed and his initial risk covered, he is now ready to build his pyramid. He will add the second portion of his intended line. And here we come to a principle that is completely counterintuitive to the amateur. This second purchase must be made at a price that is higher than the first. The amateur is always looking for a bargain, always wanting to buy cheaper. The professional is a student of strength. He understands that a rising price in a clear trend is a sign of health and power. He is not buying value in the traditional sense, he is buying momentum. He is buying a stock that is proving its own strength. So he adds his second lot on the way up. After the stock has continued its advance and proven that the initial breakout was genuine. He is buying on a scale up, a method that is the polar opposite of the amateur's disastrous practice of averaging down. This process is then repeated. If the stock continues to act right, and his now larger position continues to show a handsome profit, he will add his third lot, again at an even higher price. He is methodically building his line step by step as the market itself continues to give him the green light. This is the point of greatest mental pressure, the point where the amateur falters. It is why a speculator must constantly return to these first principles, to study them, especially after a series of unsuccessful trades, to recalibrate his mind. This channel and videos like this one will always be here as a source for that necessary study. The structure of the pyramid itself was a matter of scientific calculation for Livermore. He did not add to his position haphazardly. He had a definite plan for the grouping of his purchases, designed to manage his risk and his average cost. For a theoretical full line of 1,000 shares, for example, he would not buy them in equal lots. His initial probe might be 200 shares. After a sufficient advance, he would buy another 200. After a further advance, another 200. And then, for his final purchase, he might buy the last 400 shares. He never bought his entire line at once. The market had to earn his confidence at each stage of the advance. Each new purchase was a reward he gave the stock for its good behavior, for its continued adherence to the bullish trend. This method ensured that his position grew in size only as his confidence in the trend grew. His financial commitment was a direct reflection of the market's own proven performance. A critical aspect of the pyramid strategy is the management of the average cost of the entire line. While each new purchase is made at a progressively higher price, the speculator must ensure that the average cost of his total position remains at a safe and profitable level. The great danger in pyramiding is becoming too top-heavy, of buying the largest portion of one's line at the very highest prices, near the end of a move. This makes the position vulnerable to even a minor correction. The ideal pyramid is built on a wide, solid base of the initial lower-priced purchases. The later additions, while larger, should not drastically raise the average cost to a dangerous level. The speculator must know his numbers. He must keep his average cost at a point where a normal reaction will not turn his entire position into a loss. It is essential to understand that the pyramid strategy is a tool designed for one specific set of market conditions, a great primary trend or a big swing. It is not a method for trading in a dull, listless, or sideways market. To attempt a pyramid on the minor, meaningless wiggles of a range-bound market is to be whipsawed to death. It is a strategy for a clear and powerful trend, a market where the line of least resistance has been definitively established. The pyramid is the great weapon of the trend-following speculator. It is the mechanism that allows him to build a truly life-changing position, a massive line of stock or a commodity that can be held for the entire duration of a great bull or bear campaign. It is how a speculator transforms a correct opinion, a single sound judgment at a pivotal point, into a truly great fortune. It is the science of capitalizing on a major move to the absolute fullest extent. The psychology of the pyramid is a psychology of confidence. It requires the speculator to act in a way that is diametrically opposed to the instincts of the amateur. He must have the courage to buy a stock that is making new highs, a stock that looks too high to the timid. He must have the discipline to press his advantage when he is right, rather than snatching a small profit out of fear. The amateur is always looking to take a profit. The professional is looking to build one. The pyramid method itself builds conviction. As the position grows and the paper profit swells, the speculator's belief in the trend is constantly being reinforced by the market's own undeniable evidence. His position is a profitable one, and there is no greater source of confidence than that. It is a method that perfectly aligns the speculator's financial commitment with the proven strength of the market's trend. His greatest risk is at the beginning, on the small probe. His greatest commitment comes only after the trend has been proven to be powerful and real. In the final analysis, the pyramid strategy is the ultimate expression of professional scientific speculation. It is the blueprint for building a fortune from a single correct idea. It stands as the perfect and logical opposite to the amateur's emotional and illogical process of averaging a loss. One method is a reinforcement of failure, a subsidy for error, an argument with the tape. The other is a reinforcement of success, a reward for correct judgment, a harmonious partnership with the trend. The philosophy is complete and irrefutable. First, one must test the market with a small exploratory probe at a pivotal point. Second, one must wait for the market to provide proof in the form of an immediate profit. Third, one must use this profit as the risk capital for the rest of the campaign. Fourth, one must add to the position only as it continues to advance, buying on a scale up, never on a scale down. And fifth, one must manage the size of the purchases to keep the average cost of the entire line at a safe level. The man who masters this one, single strategy, has mastered the difficult art of converting a sound opinion into a truly great fortune. He has learned that the market itself will finance his greatest successes, if only he has the wisdom to listen to its guidance and the courage to act upon its clear and unmistakable commands.